A phrase you occasionally hear financial professionals use is alternative investments. It generally refers to assets other than equities and bonds. Alternative investments are particularly popular with institutional investors, not least for the potential they offer for higher returns. Venture capital is a good example.
Venture capital is essentially investing in startups that have the potential for high growth. And that tends to be usually technology companies. Now, it is worth mentioning that it is a very risky asset class, and it's simply down to the business model of the venture capitalist. So if you think about investing in 10 startups, the expectation of that venture capital investor is effectively that 6 or 7 of those will go broke, you lose all your money, 2 of those will break even, and 1 will become the star.
So a big disadvantage with venture capital is that it can be very risky. Something else that should put you off it is the relative lack of transparency compared with public equity markets.
Investors should in general be very careful with any returns from any private asset class. So from venture capital, from private equity, and even hedge funds. And the reason for that is that there's a number of biases which tend to overstate returns. And the simple example of that is if you have a hedge fund or venture capital fund that's done a lot of investments that are going sour, usually they stop reporting. So that means that the indices where we can analyze the industry effectively always show the surviving entities. And that survivorship bias and reporting bias effectively that venture capital data from a return perspective often is overstated. And the average returns that investors would truly realize are often a little bit lower than that. The other component, what's worth highlighting about venture capital, is that returns per se are actually not impressive. So if you look at the average venture capital returns, they're almost the same as for the Nasdaq.
That raises an important question. Why would you want to invest in venture capital when you can get similar returns and similar exposure to small, mainly technology companies by simply tracking an index like the Nasdaq at much lower cost? There is, though, a much more fundamental problem with venture capital for ordinary investors, and it's this. The best funds you're simply not able to invest in.
Some funds do manage to generate truly fantastic returns, the best performing VC funds, and those are a lot better than we can take from any public market. The underlying issue is, of course, that only few investors can get access to the top performing venture capital funds, and per definition, it's only the majority only has access to average venture capital funds or the underperforming ones.
For most investors then, venture capital is best avoided. Those who do invest are more likely to enrich the asset managers than they are to enrich themselves.